Throughout 2025, the headlines told one story. Stock markets reaching record highs. The S&P 500 climbing. Tech stocks soaring. Economic strength celebrated everywhere. Retail investors poured money into index funds. Retirement accounts grew. Confidence seemed justified. But behind the scenes, a different story was unfolding. The people at the very top were doing something else. Something quiet. Something deliberate. They were selling. Not small adjustments. Not modest rebalancing. Massive exits from their own companies. Over $16 billion in insider stock sales during 2025. Billionaires and executives cashing out while markets celebrated. Jeff Bezos sold billions in Amazon shares. Mark Zuckerberg reduced his Meta holdings significantly. Jamie Dimon executed his first major JP Morgan stock sale in years. Executives at Nvidia sold near peak prices. Microsoft insiders reduced positions. Google leadership did the same. Tesla executives followed the pattern. This wasn't one or two outliers making personal decisions. This was widespread across the wealthiest investor class. The official explanations sounded reasonable. Diversification, estate planning, pre-planned trading programs, tax considerations before potential policy changes, philanthropic commitments. All technically plausible, all perfectly legal. But the timing raises questions. Why now? Why so much? Why so many doing it simultaneously? History offers uncomfortable answers. In 2007, major insider selling preceded the 2008 financial crisis. Executives reduced exposure roughly 12 to 18 months before markets collapsed. In 1999 and 2000, tech company founders and executives cashed out billions before the dot-com bubble burst. They sold while optimism peaked. In 1987, concentrated insider selling preceded Black Monday in October. The pattern repeats. Insiders often reduce exposure 12 to 18 months before major downturns. It's not a perfect predictor, but the correlation is notable enough to pay attention. So why do insiders know first? They have direct access to company performance data before it becomes public. They see revenue trends, customer behavior shifts, margin pressures building. They understand competitive threats that haven't hit headlines yet. They know whether their companies can meet the sky-high expectations Wall Street has set. They talk to other CEOs and board members. Information flows through networks most investors never access. And crucially, they read economic indicators through their own businesses in real time, not through delayed government statistics or analyst reports. If orders are slowing, they see it immediately. If customers are pulling back, they feel it first. This creates an information advantage, and that advantage often translates into better timing. But here's the interesting part about timing. Why don't they sell right before a crash? Several reasons. First, it would be too obvious. Potentially invite regulatory scrutiny or legal questions. Second, during panic, executing large sales becomes difficult. Buyers disappear. Prices gap down. Liquidity evaporates. Third, selling while markets are strong allows maximum value extraction. Get the best prices while demand is high. And finally, it provides liquidity well before potential turbulence. Cash in hand. Options preserved. Flexibility secured. The sales in 2025 suggest concern about conditions in 2026 or 2027. An 18-month warning window. If this pattern holds, the next 12 to 18 months become critical. Markets might continue rising. Optimism might persist. But underneath, the people with the most information have already made their move. They've headed toward the exits. Quietly, methodically, while the crowd still pushes in. Does this guarantee a market downturn? No. Insiders can be wrong. Markets can defy expectations. But when Jeff Bezos sells billions in the company he built, when Jamie Dimon sells JP Morgan for the first time in years, when this happens across sectors simultaneously, it deserves attention. The question isn't whether they're definitely right. The question is, what do they see that most investors don't? And should you be paying attention to where the smart money is moving? Let's examine what was actually happening in markets and the economy during 2025. Stock valuations reached historic levels. The S&P 500 traded at price-to-earnings ratios in the top 10% of all historical periods. Tech stocks particularly elevated. Companies valued at multiples that assumed perfect execution for years ahead. Markets were pricing in continued economic growth, stable corporate profits, and accommodative financial conditions. On the surface, everything looked strong. But beneath the surface, cracks were forming. Corporate profit margins began showing pressure. The pandemic boom years, where companies raised prices easily and demand stayed strong, were ending. Consumer debt levels reached new highs. Credit card balances, auto loans, and personal debt all elevated. Americans had borrowed heavily to maintain spending. Commercial real estate continued showing stress. Office buildings sat partially empty. Refinancing became expensive as interest rates stayed higher than the previous decade. Interest rates themselves remained elevated compared to the 2010s. The Federal Reserve had raised rates aggressively to fight inflation. Even as inflation moderated, rates stayed well above the near-zero levels investors had grown accustomed to. The labor market softened from its peak tightness. Hiring slowed. Job openings declined. Wage growth cooled. These weren't crisis conditions, but they were shifting conditions. The easy growth environment was changing, and insiders could see this directly through their own companies. Revenue growth was slowing from the explosive pandemic-era levels. Customers were becoming more price-sensitive. Competitive pressures intensified as every company fought for slowing growth. Margin compression became real. Wages had risen. Input costs stayed elevated. Pricing power weakened. The equation was tightening. Massive investments in artificial intelligence showed uncertain near-term returns. Billions flowing into infrastructure and development. Promise of future transformation. But immediate profits remained unclear. Regulatory pressure increased across sectors. Antitrust scrutiny of tech companies. Financial regulation discussions. Environmental requirements. Compliance costs rising. All of this created a challenging environment for maintaining the growth rates that current stock valuations required. And here's the critical point. Many stocks were trading at prices that left no room for disappointment. Valuations assumed everything would go right. Revenue growth continuing. Margins holding. Competition staying manageable. Regulations remaining light. If even one of those assumptions broke, valuations could compress sharply. Insiders know whether their companies can actually meet these expectations. They see the quarterly results before anyone else. They understand the challenges intimately. Their selling suggests doubt, not certainty of collapse, but doubt about maintaining current trajectories at current valuations. There's a concept in behavioral economics called the greater fool theory. Assets can stay overvalued as long as new buyers keep arriving, as long as someone is willing to pay more than you did. Insiders may be identifying the late stage of this cycle, the point where sophisticated money begins exiting, where the composition of buyers shifts from experienced to inexperienced. When that happens, who's left holding when sentiment shifts? History shows retail investors are often the last in and the first hurt. Now, there are alternative explanations worth considering. Tax and policy uncertainty played a role in 2025. Capital gains tax changes were being discussed. Estate tax modifications debated. Wealth tax proposals floated, though unlikely to pass. After the 2024 election cycle, policy uncertainty for 2025 and beyond was elevated. Locking in gains under a known tax regime made rational sense. It's also true that insiders don't always predict correctly. There have been periods of heavy insider selling before continued bull markets. In 2012 and 2013, executives sold before massive tech rallies that lasted years. Sometimes diversification is just diversification. These people are already enormously wealthy. Protecting what they have makes sense regardless of market outlook. They can afford to miss upside if it means avoiding downside. And they can be wrong about timing just like anyone else. Having information advantages doesn't eliminate uncertainty. But here's what makes the 2025 selling notable. The scale. $16 billion is unusually large for a single year. The breadth. This wasn't isolated to one struggling industry. It spanned tech, finance, consumer goods, multiple sectors. The concentration. Many sales happen within specific months, not gradually over years. The context. Coming after a historic bull run, at elevated valuations, during an economic transition. This combination mirrors patterns seen before previous major downturns. Not identical, but similar enough to warrant attention. So the billionaires are selling. Does that mean you should too? Not necessarily. And here's why the answer is more complex than it seems. Billionaires have different risk profiles than ordinary investors. They're already wealthy beyond what they could spend in multiple lifetimes. Their focus shifts from growth to preservation. They can afford to miss upside if it protects them from downside. Average investors often need growth to reach retirement goals. Selling too conservatively might mean working longer or retiring with less. Blindly copying billionaire moves without considering your own situation can be a mistake. But ignoring their signals entirely can also be a mistake. History suggests major insider selling often precedes downturns by 12 to 24 months. But markets can continue rising substantially during that window. Selling too early means missing gains that could be significant. Staying too long means potentially catching a major decline. Timing markets perfectly is nearly impossible, even with insiders selling data. So what's the right approach? Start with a risk-reward calculation based on current conditions. If insiders are correct about a 2026 or 2027 downturn, protecting capital now could help you avoid a 20 to 40% decline. If insiders are wrong and markets continue higher, you miss some potential gains. But here's the key insight. At elevated valuations, upside potential may already be limited. Risk-reward becomes asymmetric. More potential downside than upside. This doesn't mean sell everything and go to cash. That's market timing from the other direction and equally dangerous. Instead, consider practical adjustments. Review your portfolio allocation. Are you overweight stocks relative to your risk tolerance and time horizon? If your equity allocation has drifted too high because of market gains, consider rebalancing. Build cash reserves, not just for safety, for optionality. If markets decline, cash gives you the ability to buy quality assets at lower prices. Shift from speculation to quality. High-flying growth stocks with no profits are most vulnerable in downturns. Stable companies with real earnings and dividends provide better protection. Diversify beyond stocks. Bonds may provide ballast if interest rates fall during a recession. Gold and commodities serve as hedges during uncertainty and inflation. Real estate provides tangible asset exposure. International holdings reduce single-country risk. The goal isn't to eliminate stock exposure. It's to position for multiple scenarios. As 2026 and 2027 unfold, watch specific indicators closely. Corporate earnings reports. Are growth rates slowing more than expected? Are companies missing estimates and guiding lower? Insider activity. Has the selling continued, accelerated, or have insiders stopped selling and even started buying again? Credit spreads. The difference between corporate bond yields and government bond yields. Widening spreads signal increasing financial stress. Unemployment rate. Is it trending upward? Rising unemployment often precedes recession. Consumer spending patterns. Are people pulling back on discretionary purchases? Increasing savings rates? The yield curve. If long-term rates fall below short-term rates and stay there, recession often follows within 12 to 18 months. Federal Reserve policy. Are they cutting rates aggressively? That usually signals economic concern. These indicators together provide a clearer picture than any single data point. But here's the hardest part. The emotional discipline. Acting before the crowd feels uncomfortable. When markets feel great, adjusting your portfolio feels wrong. Like you're missing out. When markets eventually crash, panic selling feels right even though it usually locks in losses at the worst time. Billionaires adjusted their positions while everything looked good. While optimism was high. While their companies were hitting records. Can you do the same? Can you act on information rather than emotion? For younger investors with decades until retirement, volatility is less concerning. Time heals market wounds. Staying invested through cycles builds long-term wealth. For those approaching retirement or already retired, severe drawdowns can be devastating. Less time to recover. More immediate need for capital preservation. Your situation determines your appropriate response. Here's the ultimate reality check. Billionaires could be completely wrong. Markets could continue rising through 2026 and 2027 and beyond. Their track record isn't perfect, but it's good enough that ignoring them entirely seems unwise. The cost of being cautiously positioned and being wrong? Missing some gains. The cost of ignoring warning signs and being wrong? Severe drawdowns that take years to recover from. Which risk fits your situation better? Only you can answer that. But now you have information most investors never consider. Billionaires don't broadcast their portfolio moves. But the data is public through SEC filings if you know where to look. $16 billion moved to the sidelines in 2025. An 18-month warning window potentially opening. Whether that warning proves accurate or not, having the information gives you an edge. Combine it with valuations, economic data, and your personal circumstances. Make informed adjustments, not emotional reactions. If this gave you a new lens for reading market signals, hit subscribe. Billionaires don't broadcast their moves, but the data is public if you know where to look. The answers aren't in predictions. They're in the patterns that history keeps repeating.